welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis, Missouri. Today, I have the pleasure and privilege of speaking with Kirk Michie in San Diego, California, and he is the founder of Candor Advisors. For more than 30 years, he has worked with entrepreneurs, closely held business owners, and high net worth families to achieve their strategic planning, liquidity, investment, and legacy objectives. Today, we're going to talk about using valuation metrics to strengthen the seller negotiations in M&A or mergers and acquisitions. And I welcome you, Kirk, to the podcast.
Thanks, Melissa. I'm glad to be with you.
Now, I do normally start off with people just going straight into the questions, but I think that you have a little bit unique perspective of M&A and exit planning and such. And, you know, you and I are a lot aligned in that this could be a more holistic approach for the sellers, and that quite frankly, maybe the M&A and the selling environment has just been a little bit toxic in the past, and it really spits out these relationships that maybe, you know, went through this hard negotiation and they're not totally friends, and now they're going to into a partnership or, you know, this transaction. So Kirk, could you just give us just a little bit about you and your experience and what your perspective is to what this looks like, you know, now and going into the future for M&A in general?
Yeah, absolutely. So, I mean, look, for more than 3 decades, I've been in financial services, and for the last 12 or 13 years, focused exclusively on M&A and, you know, capital events for successful founders. And I was a partner at a private equity firm when I had this moment of clarity around the idea that we had a distinct advantage over these founders who built these great businesses, but we understood deal terms much better than they did. And, you know, when I started Candor Advisors 4 years ago, it was with the idea that the buyer of your business is a full-time predator, and you as a seller are part-time prey. And you really do need to armor up. And I don't mean that it has to be, you know, kind of a battle, but I do know that, you know, kind of human nature is what it is. And what ends up happening with buyers, I mean, it starts with, if you go to a database like Crunchbase or something like that, you're searching, even the terms are like target company, right? So like, you spend 30 years or 50 years or multiple generations building up a family bakery or machine shop or distributor. And you don't know that there's a bunch of capital out there in the hands of, you know, MBAs who have no operating experience in your world. And they're planning to come by you with as little cash as possible, as much structure as they can, so they take on as little risk as they can, but own as much as they can. You have no idea that that's happening. And so our perspective is, look, we can be on that wall. We can be your shield. We can be, you know, the gladiator on your behalf, and make sure that when you move your transferable economics to a new owner, that you get paid for what you should get, and that you get to hang on to it. That there isn't a whole bunch of contingencies, that, you know, there aren't things that can get clawed back, that, you know, so like our whole kind of operating thesis is there may be $1 trillion worth of dry powder out there, but, you know, for every $30 million software business or manufacturing company or whatever else who doesn't know that those buyers know so much more than they do, they need help.
Well, and I think the buyers know more about it, but they also are, you know, looking at opportunities. So they're not willing to just overpay in some of these situations. And,
Right.
you know, even if we stick on private equity a little bit, because we're not yet talking to the open market, you know, like you're talking about some, you know, beginning stage companies, and we have several that are kind of going through rounds of funding, and they're like, you know, no one likes the valuation. And I'm like, no, the valuation is based on the projections, and they may not like the projections. What's your perspective? Because I'm like, the valuation number is a negotiation. Like, you're saying what the valuation is based on your projections, and they're telling you they don't agree with something. You got to figure out what they don't agree with. And my thing is, they might not agree with your projections. What else could they not agree with? That is like, you're not providing the value, or how would your perspective from private equity be if you're saying that to us, saying, oh, we don't believe that valuation. We want more for less, right?
Yeah. Yeah, it's trickier in the early stages because you are talking about the total addressable market and how much of it you think you can capture, and whether your mousetrap is actually better than what's out there, or whether your disruption is needed, or it's just different and has never been done because it shouldn't be done, right? And so, like, for every, Adam Newman or Elizabeth Holmes, there's Toby Lutke over at Shopify, who's trying to build the greatest 20-person company in the world, and fails miserably by having 1,000-person company and having to hire a CEO, and like, the valuation or the value of his business is obvious. Whereas over here, they've convinced some really, really smart people who have a bunch of capital that they're worth a lot. And in those early stages, I think there are usually really sophisticated people on both sides, but at some point, somebody makes a leap of faith and a bunch of other people follow, and it turns out to be right or not, which is why, incubators invest in so many different companies, figuring that, most of them aren't going to work out. When you get to the world of actual, cash flow and, EBITDA and, annual recurring revenue and net recurring revenue and logo retention and other metrics that signal to financial buyers that there are some things that they can analyze that actually have some history to them. Well, then there can be, a healthy business person's debate about whether something's worth, 6.5 times or it's worth 9 times, those metrics. And ultimately the market decides that. But it's really, really interesting that, in early stages, I have talked to venture capitalists who are certain that they're right about the idea that no one should have a valuation above $10 million when they don't have a product or a prototype or whatever else. And then I say, okay, so let me see if I've got that right. When Peter Thiel co-signed the lease for Facebook and injected $500,000 of capital, and the valuation was way above $10 million. Like, did he make a mistake? Did he not get the memo? I'd be like, so I think, there's an art to valuation, and then there's a science to valuation. Right.
Well, and even in the startup world, and I've told people this, I've said, either they're going to say you're worth $1 million or 10 million. That's just the metrics. You're either at the stage where you haven't really proven anything, and you might be at like default $1 million. And then, or you're at the stage where maybe you've proven something and it's really between $1 million and 30 million, but they're just going to default and say, okay, 10.
Yeah, that you're probably as simple a way of putting it as that is, you're probably spot on. That's probably exactly how it happens. And I will tell you that the way we think about the difference is that venture in early stage is concept risk, and later stage private equity or strategic buyers, that's execution risk. Does somebody believe that they can add their capital, strategic guidance, and operating expertise to make 2.5 to 4x their money using leverage or not by buying a successful business, right? So they believe that from an execution risk standpoint, they can do better. And, that may or may not be true. I don't understand, like when I read that KKR sells a business to Vista, or, that TPG sold a business to Platinum or something like that. I don't understand how one private equity firm that's got like, recently minted brilliant MBAs like falling out of the windows. They've got so many of them. I don't understand how that firm believes that they're so much smarter than the other firm, that they're going to squeeze more juice out of this fruit, right? I don't understand that. We only work with selling founders, and we only work, first time transactions. It's not like we wouldn't work on a second or third time, but we don't even work with hired CEOs. We want to work with founders. We want to work with the people, that spent their weekends having to go to Staples to buy office supplies to keep the business running. And yeah, sure. Now, they've got 2 million or 5 million or 20 million of EBITDA, and they pay themselves out nice distributions, and they're really, really comfortable. But we want the people that have the daily existential risk of, is this thing going to survive? That's the person we want to be talking to. That's the person we want to represent.
Well, and right now, I think that is the like I've talked about this in some capacity to other investment bankers and business brokers. But right now, the deals that I'm seeing, because of course I'm doing valuations and I'm doing strategic valuations. So companies are valuing every year to just see like partners buying in or out, or, building up the management team by providing some sort of compensation of ownership. And so they're knowing where they are in a valuation standpoint and where they want to be, right? They understand some of their EBITDA. So what they're getting is a knock on the door. They're getting somebody coming to them, either a close competitor or a close friend competitor, right? They see them at the association. They talk to them and like, hey, what are you doing? You buying things? And they're starting to do these deals of like, well, I'm a founder and you're a founder, and we could do this a lot. Like, let's not get everybody involved. And we know some of our value metrics, when we started talking about this podcast, we were like, okay, but the valuation metrics, right? Because I'm telling clients not to get a full valuation report, because you just need to know like your range. What's your reasonable range of like, how high do you think you could get it? How low is it going to be? And that's still going to be based on cash flow, risk, and at all times kind of getting to an LOI or a letter of intent or a letter of interest. And so in most situations, I'm like, hey, let's not do this valuation and put it in writing and then have somebody call you and say, hey, can I have that in due diligence? And then you look like the jerk for not giving it to them. How can sellers actually use some of the valuation metrics as leverage to push for a stronger LOI, a better purchase price?
Yeah.
And really, the metrics in valuation is cash flow and its risk, or market multiples and things like that. Like, how are you seeing a business owner should be prepared when they're going into this situation?
Yeah, it's a great question, because what we see on the unsuccessful end of things is that the sellers that it doesn't work out for argue with the market. They won't acknowledge that, at my level of, revenue, EBITDA, customer concentration, unique IP differentiation, the market is paying 6 times, but you don't understand, my thing is more of a jewel and I deserve 9 times. And usually that's either ego or the need to have more money to be able to retire the way they want to retire, right? So acknowledging that the market decides on the valuation, and no, you shouldn't take it personally when the market tells you that, hey, look, you're a 6 times business. You also shouldn't take it personally when somebody calls your business a nice lifestyle business, because it probably is. Now, can it be more than that? Definitely. And one of the things you do, or, we coach people to do, is to sort of say, look, if the valuation range for businesses like yours, because we've gone and looked in the databases and found precedent transactions that are relevant and that we can find information about, and we know who those buyers are, so we can create a buyer universe. Let's reach out to those people. If you're okay in the range, what our job will be as your investment banker, as your financial representative out there talking to all these unfamiliar people and vetting them, is we can create some competitive tension to make sure that, we can at least try and drive the high end of the valuation spectrum. But we also tell people that, listen, understand that the way great negotiation works when it comes down to smart merger and acquisitions or buyout discussion is seller's price, buyer's terms, buyer's price, seller's terms. every single deal point needs to hinge around those things, right? So if the buyer agrees to pay you 8 times, even though they really wanted to pay you 7 times, well, then you're probably going to have to accept more structure and get less cash, right? And if you say, no, I'm going to push back on that, you're violating kind of the social contract that you go into when you've got a willing buyer and seller, which is to say, well, he met you on price, so you need to meet him on terms. Now, if he comes back and says, I'm going to do 60% cash at close and 20% equity roll and 20% earnout, you can say, I'm willing to do earnout or equity roll, but I'm not willing to do both. And so now you've basically continued the, buyer's price, seller's terms, seller's price, buyer's terms. Then they come back and they say, okay, we want an EBITDA based earnout. And you say, well, listen, you're buying the majority of the company. You're going to control the expenses. So I can no longer control EBITDA. Why don't we stipulate that this is where the multiple of revenue is, and we'll do a revenue-based earnout. I can live with the earnout for 40%, but it needs to be revenue-based because I can no longer control EBITDA, right? And if the buyer really, really wants the company and the seller really, really thinks that this is the right legacy for their company, they're matching, the seller's reason for selling and the buyer's thinking about what's going to happen with the company, then you get to a transaction without anybody yelling at each other or pounding the table. I mean, sure, let the lawyers, make faces at each other on the Zoom calls and, harumph under their breath and whatever else. But if the principals kind of come together around those things and there's advisors are giving them good guidance there, deals get done. And so the founders can use an awareness of the valuation of the marketplace to drive those terms.
Yeah, and I think that even understanding where your position is in comparison in that marketplace, because again, not all competitors are the same. Like, what are your uniquenesses? What is somebody really wanting to purchase from you, or what is your uniqueness that you're out there selling? But it usually gets to a price, right? And so what happens is they maybe talk to their financial planner, and the financial planner is like, hey, you need about 5 more million to live happily. And that's like, and then of course they don't tell you that's 5 million after tax. So like, I got to gross that up. So now I got to go get like 7, 8, 9, 10 million. Okay. And depending upon the deal transaction. So in that situation, we're almost building up to a number that we need that doesn't have a basis on anything. And really where a valuation should come in is to provide you that sanity. Like we've talked about the floor of, here's the fair market value is like willing buyer, willing seller, right? So here's the cash flow. You're making 500,000 at the bottom line. And even if I think I can go do something great with it, 5 times EBITDA, or let's call it EBITDA, is going to be 2.5 million, right? So let's just do like just stupid, simple math. Let's just say that's your valuation and that's your price. And you put it out there for 2.5. Of course, we know there's other issues like inventory and all these other balance sheet items. We get that. But for the sake of just like, if you got 500,000 of cash right now, it could be worth 2.5 million. If you need 7, 8, 9, 10, I can't just get you there by you saying, I think it's worth more. I would like to put that price on it. The valuator is saying, hey, at a minimum, you can get 2.5, but now you need to go to your investment banker or your broker and say, is the market? Because again, if I told you that was a telecom company, that's going to be a different, I know that those are priced on revenue. So I don't care that you're only making 500 to the bottom line. You have 3 million in revenue. Now I might be able to get you to your 9 million. Okay. Because I understand the market and I understand how things are pricing them on the market. And I'm going to give you a rational range. The M&A person should go and get you a home run based on the buyer's perspective or the terms. But in my mind, and what you just said, you're not necessarily going to get a home. Like, I don't want to be Debbie Downer, but like, getting a home run for traditional, really good businesses is maybe a little aggressive in a thought process. Like that might be, I mean, you tell me, but the more reasonable a seller can be, the odds are they're going to have a very successful transaction.
Absolutely. Absolutely. Look, I think it's important to believe wholeheartedly that your business is better than all of your competitors. I think that drives, persistency through the hard times. And I also think that, depending on what your advisors know about what your kind of non-negotiables are and how well aligned they know the buyer to be, they can work on some of this stuff. I can think of a couple of transactions that we've been involved in, both, pretty healthy 9-figure deals where, in the one case, we were, we sort of built the deal team. We hired the investment banker, the M&A lawyer, the quality of earnings accounting firm, and we coached the founders through the deal. So it wasn't like the investment banker had to talk through us, but we were in every meeting and we were sort of interpreting, and that the founder really trusted us for some reasons that aren't really all that germane to this story, but they really trusted us. They wanted us in the mix. What we knew that the investment banker didn't know was that this client was already very wealthy, and that unless they got what was an above market multiple, they wouldn't sell. Their plan B was to just keep operating. This is a business that had an 82% EBITDA margin. And they were splitting essentially $10-12 million a year of distributable profits. And these were people that had already bought all the things they wanted to buy. So what we did in that transaction is we never told the investment banker that there was a hurdle that had to get over. We just encouraged the investment banker to create as much competitive tension so that we had as many options among the multiple buyers that we had. So we got to a great transaction, and nobody ever had to be crazy about any of that. We also were involved in another 9-figure transaction about a year and a half ago, where the CEO of a European public company, was at a conference in town where I live. And, the corporate development person on his side said, we're not going to pay your client what your client thinks their business is worth, unless you can convince the CEO of the public company to then go back to the board and tell them that they need to pay more. And I met him for coffee at the Hotel del Coronado. We spent an hour together, 48 minutes of which was talking about how our adult children are more interested in our approval than our advice, and nothing about the deal. He said, I think your client's crazy. I think your client is unrealistic about what he wants for the business. And so I wanted to meet with you, but I have to tell you that we're not going to meet your number. And I said, I completely agree. My client wants a lot more for his business than the market would suggest it's worth. It's a shame that you, with your PhD in neurobiology, and me with, my kind of command of numbers, can't come up with a way to get him what he wants without you taking much of a risk. And, all of a sudden he's kind of quizzical in that moment. And I explained that their public company multiple was about 5x, 5 turns more than the private company multiple they were paying to my client. So I explained to him what the EBITDA was worth to them in terms of market capitalization. Yes. And then I explained to him that if he was willing to do what effectively was a risk-free earnout for anything above EBITDA in this case, I even told him this makes us vulnerable because you'll control EBITDA. But if we can increase EBITDA over the next 2 years, you can still arbitrage the difference between your market multiple and what you'll pay my client. So you make money no matter what. And you look like a hero with your board because you can explain this to them. And so look, this guy was so much smarter than me on so many other areas. We connected around why this business would be good for him, that my client was unrealistic. We agreed on all that, and we figured out a way to make the deal work. Right.
Well, and here's my theory. Like, I I completely agree with you. Since I work with business owners that are literally getting buyers come to them, I'm like, the sellers have changed and the buyers may not totally realize, especially if they're institutional and above, like, because other buyers who are just buying like their first or second company, like they're as oblivious as the sellers are, right? You're almost guiding both of them of like, hey, buddy, you're gonna go. Did you get your finances? Like you're kind of like they're seeking some advice, which is very interesting. But I've talked to other people about eventually there will be a marketplace similar to a public marketplace, but it's a private marketplace and like an app that we're like, hey, Melissa Gragg is for sale, and it looks like that it's going to be, and I have a price. I say it's $2 million. And that's what melissagragg.com business is worth. And it's interesting. And I think that if we are more realistic and rational about how we are pricing ourselves, even if it is a premium price, because we did this and I thought it was crazy, but I'm going to ask what you think about it. We put together a transaction that really the owner wanted a certain price. And I said, you know what, the best thing to be, and it was, a price that maybe the valuation couldn't support, but it was very realistic as well, right? So there's this beautiful range that is all realistic, but maybe not as provable or supportable, right? There's some risk there. And I said, let's just tell people what we want as the price. And let's not beat around the bush, because I said, you're not going to enjoy this process. And you're going to feel like it's a rude for them to say this number. So why don't we just position the price? And it's interesting because we had a couple of very, large buyers that had cash in hand. And one of them said, well, that's the price that they said. One of them said, oh, well, this price, it seems like it's got some blue sky in it. And I wish you would just call it blue sky. And I was like, fine, call it blue sky. Does that make you happy? And he's like, yeah, it does. And I was like, okay. Another one was like, hey, that I know, I know this guy, I know, we want this company because the brand and all of this. And if that's what he wants, that's what I'm going to do the deal for. And now that was the buyer that we wanted the most, right? Like we were doing all of this for that one person. And when he said that, it was so interesting because we shifted immediately. There was no real discussion about price for the LOI. It was now terms. And so in some kind of situations, I think we have to just kind of discuss, so in my mind, like I didn't have to do much more, right? Like I got the great buyer. Now I got to negotiate terms. But even before we get into that, I think that an LOI and a letter of intent or a letter of interest or some sort of beginning piece, not everybody totally understands, right? They want to say they understand this process because they want to look smart, and I think it would be helpful if you could just even talk about some of the key factors that you're looking for when somebody delivers that LOI, because those are the terms that we are negotiating at that beginning level.
Yeah. Yeah. So that's a really important thing to drill down on, because I think, look, it can seem somewhat controlling, but I think it's the responsibility of a good transaction advisor to either communicate, in discussion or by email, or actually formalize the bid process so that the buyers know what's expected. And so when we run a full process, we're going somewhat narrow, like maybe we're only approaching, 24 groups, or really, really broad. We're going to 200 different potential buyers. When we put the teaser and the non-disclosure agreement out there, we also include a bid process letter. We want everybody to know right up front that indications of interest are due on this date. We're going to provide the following information in a data room so that you can send us your indication of interest. And these are the things we'd like to see in the indication of interest. With a business that's not going to have a lot of buyers, you got to be a little careful there, because you can make your party so exclusive no one wants to come. But if you think you're going to have, like the last time we did that, we had 35 groups request the SIM, and 20 of them did, meetings with us. We told everybody that they weren't going to get a management meeting until we went to the LOI round. We gave guidance because we talked to a number of private equity firms before we went. We looked at the database on transactions, but then we talked to a few private equity firms that were not going to be bidders on this to say, what do you think our guidance ought to be in a range? And they said, look, if I were a bidder, this is, I would be between probably 5.5 and 6.5 times ARR, or 8 to 10 times EBITDA. I think that's the range you ought to give people. So that's what we did. We didn't say the seller is looking for X. We knew where our seller's bottom line was. But when people asked us where we thought it would trade, and 7 private equity firms, independent sponsor or big funds, out of the 19 that were interested in sending indications of interest, tapped out because we gave them guidance. And they said, I don't doubt you're going to get it, but that's too rich for our blood. We can't make our multiple of invested capital if we pay that much for this business. So thanks for letting us know. We're out. Keep us posted. The 12 that dropped in their indications of interest and the 8 that did letters of intent, they knew all along the way, not exactly what their competition looked like, but they knew what our process was going to be. They knew that it had a beginning, a middle, and an end, and we knew it had certain parameters. And they knew they didn't love it. But what we did every time we had a meeting with the buyers was catalog all their questions, and we track with Firefly, kind of what's going on in the meeting. And so we provided all of the buyers with an updated list of Q&A on what everybody else was asking. Now, some of the buyers didn't love that, Melissa. Some of the buyers were kind of like, we've got unique insights. We ask these insightful questions, and then you broadcast it to the entire group. And I said, look, my fiduciary responsibility isn't to you or the other buyers. It is to my client. And I got to be able to tell my client that we did everything we could to make sure that the market recognized the value of his business and that he got the right number, right? It's up to you to decide whether that number works for you and whether you can present yourself as the right legacy to own this business that he has spent his professional life building, right? And, I think it kind of changes the conversation when you take it out of just the numbers, but the numbers are informing part of it.
Well, and I think part of like our role in this in any capacity is to protect the seller, is to protect our client, and to provide them with a way that they won't just go through a deal because everybody's like championing it and, singing this is a great thing, or we're already invested in it and there's no way to turn back. But I think the interesting part is we're typically protecting them because some of those conversations, when they're privy to them, like I've had a couple clients that listen to a conversation, if we're on Zoom or we're recording it and keeping track of it, and they've listened to the conversations with the buyers afterwards, and they eliminated buyers immediately. Mm-hmm. And I was like, whoa. Like, what did you hear? Because I just hear us talking about deal terms and things like that. And they hear something very different, and it's very personal, and it's very, judgmental, I feel like, because again, somebody's coming in and critiquing either your cash flow, like what you've done. Oh, you've paid yourself out. Oh, you don't have enough staff. Oh, your management team's not great. You don't have a CEO. You don't have a CFO. You don't have an internal accountant. What? How do you survive? And it's just like, they go from being this, really powerful, presence in the community to going through this process that doesn't feel great. And I don't think it has to be that way in a lot of capacities. And it seems like your structure is, again, in place to get them to a position where they're in the right range. But even at the beginning, when you're looking at market multiples, when you're trying to figure out what the market is telling us, how are you utilizing, like, are you actually negotiating what the multiple is with this buyer, or are you conceptually trying to understand where they're coming from in their pricing? Or are you just giving them the rubric of which they need to show up? And if they show up, they show up, which is, you know.
Well, first, I'll double click on, how brilliant I think it is that you share, those recordings so that your buyer gets a sense of who it is that's buying their business. Because we do something somewhat similar in that when we get to management meetings, we have a proprietary scoring matrix. We give it to them with no guidance around what the weighted averages are going to be. Our side has the weighted averages on the things that matter most. But when we're in a meeting with a buyer on a Zoom call and our clients are in a meeting with a buyer on a Zoom call, there are things that we're looking for that are very, very different than what the seller is thinking about. And look, if if you're going to marry one of my daughters, I don't get to decide, but I can share with my daughter if she wants my opinion about what I think of her choice, right? So, in this very much the same way, I mean, look, if you've built up a business, you deserve to know something about what the deal people think about your buyer. If you want that information, I think, to your question about how can you use the multiples, strategically, is to essentially, like, let's say among really, really smart, sophisticated buyers, price is probably not going to be the issue. Kind of terms, long-term plan, transition plans, like, maybe one buyer is going to tuck your business into a larger platform company, and they're going to lay off your CFO because they already have one, and they really don't need your warehouse manager because they're going to use 3PLs, and they're going to so the legacy of your business is going to change. And we think of legacy as how you're impacting all the lives of the people that work in the company. And so, maybe among a group of buyers that are all roughly the same in terms of price, drilling down a little bit more on what they plan to do with the company. And then we can circle back to the seller, ask them again about their why. Why are you selling the business? Is it just to retire? And what's the next most important thing to you, right? Then we can go back to the buyers and we can say, look, Melissa, we think you're the right buyer for this business. Understand that there's another bidder that's probably a shade higher in terms of valuation, but here's what my client wants to make sure happens. Mm-hmm. And then you can put that into your letter of intent. And maybe it's maybe it's something that wouldn't normally go into a letter of intent, but the buyer wants to signal to my client, the seller, that we're going to honor your wishes for what you hope to do with this business, right? And so you can, even once you've kind of nailed or capped out on price, the LOI can capture the terms of what's most important to the seller to help one buyer differentiate from another. That's how we do it anyway.
Yeah. And I think that, for the most part, what we are doing is the valuation for a lot of financial planners, M&A advisors and everything. And they're coming to us and saying, like, what's the third, yes, we can hear what all these voices are around us, but what is a third party person who's really looking at this rational come into? And when we come into the situation, I'm coming into companies that are 20 to 100 million in revenue. They have teams, they have support. These are no nonsense people. They know what the value is in their head. They have a number in their head. And I go into it specifically, don't tell me your number, but it's going to be a fun process to see how close I either identify the number in your head or I give you a number and you're like, oh, well, that's that, so it's a fun process. But what it starts to identify is all the ickies in their financial situation. Mm-hmm. And realistically, what we are seeing happen on the market right now is everybody is looking at a trailing 12-month results. And so in my mind, even if you are a company and you want to plan ahead, you need a 12-month runway to plan to then go to market, because you've now created that trailing 12. You've cleaned up your financials. You're now on a monthly or quarterly you are looking at this strategically for how it is moving within the transaction, but you now are actually what people are looking for. You're talking the terms. When they ask you for a trailing 12 months, you're not like, what are you talking about? Like you already are geared into that at all times, you know what that rolling valuation is. In my mind, we're going to move towards that. We're not maybe in a structured sale, but we are ready for market at all times, So like I did that 12-month process. Now at any point I can pull the trigger because I am now always looking at my trailing 12. I'm always looking at strategically every quarter, what could we make a move for to get to an eventual sale that is a premium. And I think that's a different way, like that's not exit planning. That's not strategic planning. That's really matching what's happening in the market with what a business owner should have in their reality of the value as well.
Yeah. Yeah. Completely agree. I think, I think that
like even the multiples, like this is what I think the takeaway from what you're saying is like the buyers aren't coming in and being like, hey, my multiple is 3 to 8. Like they're just coming back. You're giving them all this information and they're coming back with a number. They're not necessarily telling you how they got there. Right. And I think that the business owner is so focused on the number. How do we get them to back up? How do we get them to, look at some of the risks that they have to deal with, as opposed to understanding that the number is kind of a negotiation circle, and what they're looking at is the risks or the things, like are they going to have to stay with the company, right? Are they going to have to continue to work for somebody? That's a big issue in most, like they'll ask me that first thing, like, how long do I have to stay?
Right.
And I'm like, okay, hold on. Like, what does that really mean? Well, I just don't want to work for somebody, but I want to keep working. Like I'd be working for 3 years, but I don't want to work for somebody. So it's like, how do you, right? I mean, that's what most of them say. I'm like, well, let's figure out what you really mean about that. Right. Yeah. And those are big structures in the deal. Like once you figure out the deal from a corporate standpoint, you now have to almost negotiate the deal with the owner based on what that looks like. What is their participation and exit look like for real in the process?
Absolutely.
Do you see some of that happening?
Oh, absolutely. Yeah. Sometimes it's addressed right up front. Like if you have a seller that wants to leave as soon thereafter, you're conditioning the buyers to think about that. And some buyers are going to drop out, like a private equity buyer that's got a seller who wants to go away soon, who doesn't have an operating partner they can plug into the business, or an executive already tapped. They're probably not going to bid, right?
Yeah, so I think that's that's a really good point. I think that
I think it has to come up, soon. And then, from my client's perspective, explaining to them that we want a consulting agreement for as short a period as possible, as opposed to an employment agreement, because you don't want to build and run a business for 30 years and then get a boss who's a mid-level executive at a corporation, right? So there's that. And then the other thing too is that, one of the risks that arises for sellers in terms of structure is, look, if I'm doing a majority recapitalization of my business and there's some contingent payments out in the future, am I getting enough money now so that the risk transfer is fair? Like, if I'm getting 40% cash up front, but they're going to own 60% of the business from the get-go, then the risk transfer in my mind has not happened in the right way. If I need to be getting enough money as a seller so that the risk of what happens in the future with the business is the buyers, I might agree to some of it to get more money for the business. But if I don't get the majority of it when the transaction closes, then to my mind, it's not a successful sale, because there are very few buyers who can make the case that they're going to build the business in a much better way than the entrepreneur. And so I just think that that part of the risk transfer has to happen via the terms of the LOI.
One of the things that we wanted to talk about is EBITDA University. Before we get into like how everybody can work with you, what is EBITDA University and why is it important to us?
Yeah. So we've been pretty blessed, and I always kind of cringe when somebody says that on screen somewhere, but I'll say this, that our digital marketing and our realm of acquaintance has sent us lots and lots and lots of deal flow. over time. What we found was that a lot of it was too early or not of a size that would attract a large enough buyer set for Candor Advisors to be able to go out and generate competitive tension and get the client the right price, terms, legacy control, right? So we formed EBITDA University for purpose over profit. And what we do is train founders on the things that matter most when they're going to sell their company in the future. Not just the, kind of the McKinsey and Company, hey, generate more revenue and reduce your expenses and your margins will improve and you'll get more. Like, we actually talk to them about in their sector, which things can they do? What things do the buyers in their sector want to see? And maybe even more importantly, how they can start to prepare the data room and how they can make themselves a more investable company, which might include things like reducing customer concentration, might include things like, making sure that, the right people are in the right seats. And so what EBITDA University does is just, without anything else to sell, teaches these founders how to position themselves for when they were ready to go hire an investment banker or try and sell it on their own or kind of hit the market, as it were, that they're ready, right? So for us,
which is kind of what we talked about. Like, I mean, and I think it feels like cliche to business owners, but it's the reality is that, you didn't build something for 30 or 40 years to just decide on a whim that you're going to exit and get the maximum price. Or even, again, we're not focused on maximum price. We're focused on, is it the right deal for your legacy? Because quite frankly, everybody comes in with like, oh, can I get the highest price? And then immediately you're like, here's the highest deal. And they're like, ugh, I don't like that because I don't like their culture.
Yep.
Again, that is typically, then you're starting looking like, do I want to be partnered with these people and leave my employees with these people?
Yep.
And it gets you probably in a different space. Now, you talked about Candor Advisors and what you guys are looking for in deals. Can you give us a little bit of an idea of the type of clients that you typically work with?
Yeah, so Candor Advisors is a traditional, what I would call kind of a boutique investment bank and transaction advisor. EBITDA University is a completely separate business. What Candor does is either consults to companies on a short-term basis about which things they need to do in the next 3 to 6 months to get ready to go to market. So our consulting clients are close. They're ready. They're of a size where we can create a large enough buyer universe that we can try and get them the number that they seek, right? And then when we go to market with clients in a traditional investment banking process, we decide with them based on their why in selling, whether it needs to be a narrow process where we contact only, 12.5 strategics, or it's a broad process where we engage in probably tranches, strategics, financial buyers. Are we going to include search funds? Are we going to include independents? Or are we going to, dissolve closing risk by not including them? And, we work through the buyer universe with them. And where our kind of, real kind of value add is that there are a lot of great middle market investment bankers out there that will focus mostly on the numbers. They will be very process oriented. They will have a systematic timeline. We check all those boxes too. But for us, it's all about the collaboration with the founder. We only work with 1 or 2 founders per year to sell their company. And we don't want to spend a lot of time with people that we don't naturally click with. And so I could say we're industry agnostic, but it's really more that we're really founder focused. We want to make sure that we're working with the founder, that we feel like, there's a mind meld, that we can take them to market, that they can hear bad news from us, that they can pivot through the couple of hiccups that are going to happen in every deal, that they can trust us when the private equity buyer retrades in the middle of due diligence because they found something in the financials that causes them to be able to say that they want to pay less. And that when we get to the finish line, they feel like the ROI on whatever they paid us in terms of retainers and success fee feels like money really, really well spent.
No, I mean, I think that, for the most part, you're looking at things very differently than a lot of investment bankers out there. And if they do go to your website, they're going to get the 6 secrets of a successful sale. And one of them that I thought was interesting, because of course I said you had to tell me some of them, but I think that this was my favorite one. So if we want to leave with this one, if you could just summarize your point in don't argue with the market. I'm going to use this with all my clients. I'm like, listen, you're arguing with the market. The market is telling you the truth. So what is this point as a
So look,
takeaway?
the market is a collection of, whether it's, tens or hundreds of thousands of buyers that are going to bid on your company. And if they decide that, 1.5x revenue is, the right multiple, or if they decide that 6 times EBITDA is the right multiple, look, don't argue. You can choose to not sell. You can decide to delay your path towards selling the company until you get to that number, but don't argue with the market. It's a waste of your time, and you're probably paying somebody retainers and other money to get to a transaction. And look, if the market isn't where you need it to be to get your number, so that on a net after tax basis, you can either endow the rest of your life or fund your next adventure. If it's not there, don't argue with it. Step back.
Well, and I think it's interesting because I don't think you should argue with the market multiples. I almost don't even think that you should negotiate from the market multiples. Like those are the decoys, right? Because they're subjective and my multiples can be different. I can pull up, like yesterday I pulled up market multiples in it was a marketing agency, and the multiples were literally from 1 to 100.
Yeah.
And there were transactions that spanned like 20 years. And I was like, well, wow, like pick anywhere between that. What I say is argue and support your cash flow. Because if you make them pivot off of that market multiple, this is an equation. It's cash flow times market multiple, or cash flow divided by cap rate, which is the inverse of the market multiple. And so, quite frankly, if they're going to argue on one side of the equation, then I better make sure that they don't come and start to push my cash flow, because cash flow is going to move. If they knock down 50,000 of cash flow, that could mean 5 times that in the deal. Whereas push me down 0.1 of the multiple, and I'm not going to lose as much. So I think that is an ideal. Okay, I'm going to do one more because I think these are so good. The one thing that is unique also about your investment banking advice or your process is that you start very holistically where we should all start. And you start with the why are you selling?
Absolutely. Look, if you don't know why you're selling the business, and I mean at a core existential level, why you're selling, then it's unlikely when we get to negotiations between, say, a strategic and a financial buyer that we'll know kind of what paradigm to look at your deal through, right? If you know that you can't stand running your business for any longer, you've had it with HR, or you're sick and tired of worrying about the next, financial collapse or, economic downturn, and you just want out. Well, then even if a private equity buyer is the highest bid and gives you everything you would otherwise want, they're going to want you to stay involved in the business for some period of time. That's probably not the right buyer for you, right? On the other hand, if a strategic is going to blow out, 6 of your most valued long-term employees on day 2 because they don't need your controller, they don't need your warehouse manager, they don't need your customer service lead, well, then even if they're the biggest price, they might not be the right buyer for you. So you got to know, like, is it price? Is it terms? Is it what you get to do after the sale? Is it the legacy that you leave behind? Like, look, I'm in California, so I can get a little crunchier. But I'll tell you that this, there's a practical element to this, because we can narrow the buyer universe for you. And we can make sure that you don't get your time wasted while you're trying to keep your business running and on track while we're in the midst of selling it. So yeah, it's critical.
And if your why isn't really clear, And if your why involves health concerns, if your why involves like, I need $5 million to retire, those are not leverageable whys. And those are also things that are going to cripple you in the negotiations, because the way that you really get the highest maximum price is that you're disconnected with the outcome. You're like really willing to take the best deal that comes that makes sense for you, and then willing to walk away from the deal if it's not the best deal. And I think the clarity of what we do is just to show them what the true picture is, and then allow them to make those decisions within that time frame or that framework, right?
Yeah, really well said. You nailed it. Yeah.
Okay, one more, because these are kind of good. Matching. So now let's say we started with the why when we were selling. You now then match the buyer with the buyer's why, which I will tell you, in the accounting world, there are several strategic partners that will match up the cultures of, so you have a selling accounting firm and they have these big 10 accounting firms, right? Every one of them has a different personality. And then they go to all these 10 and be like, oh, you would be a right fit with these two. Let's go talk to them first.
Yep.
Is that kind of what you're looking at, or is it even bigger than that?
So yeah, first it's, does the structure or plan of the buyer match up with the seller's why? But sometimes when it comes to negotiation, understanding what the buyer's why is really, really critical. For instance, we did a deal where the buyer is a strategic backed by a private equity firm that intends to take the company to market in 2 years. And they needed to add almost precisely my client's EBITDA before they were ready to go to market. And so we knew that, as long as they didn't feel like they were overpaying by too much, we could push them a little bit on price. And we also knew that equity roll was a reasonable thing to do in this transaction, because this private equity firm had a terrific, mid double-digit track record in terms of their IRR and their prior funds. And they were planning to sell the company in 2 years. So we didn't have to get everything in terms of price. We could get some of it in roll. But because we knew their plan, then my client's why, was well aligned enough with theirs that both sides got what they wanted. We also did another deal where, the public company was rolling up all of their previously independent distributors, and my clients was the largest in the United States. It was going to look really bad for them if they didn't get the biggest one they had, right? And my client had developed a separate business so that distributing these products weren't the only thing they did. So it would have been hard for my client to lose them, but they weren't going to get rid of my client. And so on that one, we stopped, to your earlier point, we stopped talking about multiple, and we said, look, here's the number that my clients have to get to so that on a net after-tax basis, they have the same economics that they do by owning the business. So their plan A is not selling. Plan B is selling as long as they can get enough cash flow off of their investments on the net after-tax basis that they're indifferent, in which case you can have the business. Right?
Yeah. I love it. Well, we thank you so much for being part of this podcast, and hopefully we'll have you on again to talk about more of how we can align buyers and sellers in this new kind of mergers and acquisition arena. So I'm thankful for all of the information, and we hope to see you again.
Thanks, Melissa. Really enjoyed being with you.